Welcome to Investors Insights. Our topic today, rates, housing, and markets. You probably will want to watch this entire vlog today as we give you insight about the direction of interest rates, what's going on with housing, and the impact it has on markets and economy. I just finished a great meeting, and I thoroughly enjoy working with these three individuals on our portfolio strategy side of the office, Trey Booth, Bobby Norman, and Ty Miller. Guys, great meeting this morning. Really appreciate all the research you've done, how you brought things together, and I think our viewers are really going to enjoy it. Bobby, let's start off with you because we're getting a lot of calls or emails about rates and housing and, starting to head towards 2025. So we've talked about it in previous vlogs, but talk about what's happening right now.
Yeah, now that the election has passed, we are starting to get questions about housing again, especially with rates going higher. And the good news is that our work has shown that this rise in rates has been due more towards the expectations for stronger real growth rather than growing inflationary expectations. So even with the Fed cutting rates, the rate cuts have not yielded any easing in the housing market as we had hoped. And you can see in this chart on the left that mortgage rates have increased for 6 straight weeks. And you can see the chart on the right that as mortgage rates have risen in tandem with the 10-year yield, that mortgage applications have fallen significantly. But it's important to know that some of the slowdown you see in that right chart there, the mortgage applications were due to election uncertainty. But the bottom line is a rising bottleneck in the supply of affordable homes is likely continue as will upward pressure on inflation. So for our clients looking to sell or buy a home in the coming months, there is good news, as this next chart shows. Home purchase sentiment has actually been increasing. So we'll continue to keep our viewers updated on housing as it's more of a popular topic right now that the election is over.
That's great insight. And I want to emphasize here just what Bobby talked about and what you're getting ready to hear from Trey and Ty, is that on our vlogs, you can go back and watch as we've continued to give information. You can also follow us on your social media, on Facebook, Twitter, LinkedIn, our podcast on YouTube. We like to interact with our clients, but we also like to bring you valuable information that you can use for each week. The reason I'm saying this, Trey, if they go back and watch some previous vlogs here, and especially last week, what Bobby was talking about, we were looking at down the road as a possibility, and you brought up that while everybody was ecstatic the Fed cut rates, there were rippling effects that come with that. And I want you to elaborate again on that and encourage people to go back and watch our previous vlogs. Go ahead.
Yeah, thanks for getting. So on last week's vlog, after the Fed cut rates by 25 basis points, we did point out there's several charts in there that show that that may not be necessarily a good thing. And the reason is that the market and the bond market specifically is reacting to the opposite way of what the Fed wanted. The Fed's trying to bring rates down to stimulate the economy to a certain degree because they've held rates they believe too high for too long. And the bond market's doing the opposite. Long-term rates have actually come up. And what we talked about last week is even though the Fed cut again, we would anticipate that rates may continue to rise. And there's a certain point where the stock market starts to focus on that being a risk. And that's around that 4.5% of the 10-year Treasury. And on this chart I'm going to pull up here, the purple line is the 10-year Treasury interest rate since the Fed rate cut on November 7th. You can see that it's gone up since then. And then the yellow line is the S&P 500. You can see that it did well at first, and then it's really kind of turned over. And it's that risk that long rates are going to continue to go up because most corporations, they locked in longer term rates during COVID and zero interest rates. But as they refinance their long-term rates, they're more concerned about having to refinance at these higher rates. So once the long rates are going higher, that is much more of a pass-through to corporate America. As Bobby pointed out, it's got much more of a pass-through to 30-year Treasury than what the Fed does on the short end, where the Fed is controlling rates. So something we're concerned about, that we're watching closely, is how high this goes. The good news, though, out to consumers waiting to get a mortgage and the bond market and investors that we're watching, is that we don't feel like this is a permanent hike in interest rates. At the end of this year, on January 2nd, the federal government's going to hit what's called the debt ceiling. It sounds scary, and traditionally there's a lot of media coverage of the debt ceiling and the negative impact of it. But the positive of it on markets is the federal government can no longer increase the amount of debt, so they can't borrow more. So that puts downward pressure on the supply of bonds. If the government can't issue any more bonds, there's less bonds for people to buy. And when you have the same amount of demand and less supply, Econ 101 teaches us that puts upward pressure on prices, but downward pressure on yields. So we would expect yields to start to fall once we get into 2025, which, crazy enough, is less than 2 months away. It's only 5-6 weeks away. So that's really soon. So we do expect rates to continue to rise because the Fed likely cut rates too soon and is probably going to pause at their next meeting. We don't think it's a permanent state because once we hit that debt ceiling, you're going to start to see things turn over. So something we're watching, trying to get ahead of it. That'll likely get a lot of media press on CNBC, which behind me, starting in late December maybe, but something we're watching now.
Yeah, I think we're ahead of it, and I really appreciate that insight and the way you and Bobby tied that together. And then, I looked up, and Ty, you came in to just talk about the overall economy in relation to the information that they provided. Talk about that, what you're seeing on the economic data.
Yeah, and much like Trey, this is something that we have brought up, in a previous blog of companies and businesses kind of waiting to get some clarity. We talked about it before the election. Maybe they were waiting for some election clarity, or at least, some kind of signal that, they can move forward on their industrial production and their manufacturing. And so it was kind of like they were waiting to see what would happen. And last week, we got a data point that proved that correct. October industrial production was down 0.3% in October. Manufacturing was down 0.5%. Auto production fell 3.1%. And so a lot of downward pressure. But, the Federal Reserve estimated that the Boeing strike held it down a little bit, as well as some lingering effects from the two major hurricanes we had. And so a lot of that going into play, just showing that, maybe companies were waiting before increasing their production or increasing their manufacturing. Well, then last week, we also got a report. It's one of our first signals for November that kind of, even proved this right, that October, September, October are behind us. November going forward may be a different story. And so we got the New York Fed Manufacturing Index. This surged to its highest level in 3 years. It was at a negative 11.9 in October and went all the way up to 31.2. Pretty shocking, rapid move there after holding back in September, October. It seems like businesses got some clarification that they needed, and they are ready to move forward. And this can be a good sign, not only for overall U.S. manufacturing. New York is part of the U.S., typically a leading factor there, but also economic growth, investor confidence, possibly a stronger dollar. There's a lot of factors here that can lead into this strength. And it's good to see that the company's got the clarification they needed going into year end here. And we'll see how this number plays out after this big initial pop.
Thank you for saying all that and tying all that together. And I will just say to our viewers, I know the holidays are coming up. Thanksgiving is not far away. There will be those of you getting with family and friends. And hopefully, as you're sitting there at the dinner table or socializing, somebody will say, I cannot believe rates have gone up after the Fed cut. And we can help you out you can point this out to them and give them information. And you can say that you got it from Five Plan Partners, their insight, the blog and research that we do. So we hope you have a great week. We thank you for believing in us. And we hope you find this information valuable, that you share it with others. All of you have been great about doing that. And we just want you each and every day to know that we strive for our clients to have a better, richer, fuller life. And this vlog is one way that we do it. Have a great week. We'll talk soon. Take care.